My name is Dave Coker. This is Talking About Finance for Sunday, March 28th. What's going on in my circle? 7 slides for 7 days. This is something we've been sharing back and forth, a bunch of us. 50 years ago, this cost of living analysis on the left-hand side, or table I should call it, on the left-hand side came out. I wanted to draw your attention to a couple things. First of all, you can see a new house costs $25,200. And an average income was about 10,622. So that means that the average home, pardon me, the average income ran about 42% of the cost of the average home. Fast forward 50 years, and we can see that the average home now costs $246,000. Seems like an eye-popping increase. But take a look at the average U.S. household income. 87,864, or roughly 35% of the cost of an average home. Now, we all know averages are misleading. We really should be looking at median for both slides, but it kicked off a bunch of chatter in my group, and I was quick to come up with the data rather than simply say, it's out of control, things like that. People were getting a little weird about it. So if you are earning roughly the average, homes are actually cheaper than they were 50 years ago. The other matters, the other data we'll review, or you can review on your own time. Well, debt is coming to market, and this is an interesting slide. The Treasury, and we know America is borrowing significant sums of money, and the Treasury is financing that. And just look at this. Over the past 2 years, we've seen roughly a 50% increase in the size of, this is 2-year Treasury notes only, of 2-year auctions. So they're pushing more and more debt out there into the market. And it's very curious because who is buying this garbage? You'd have to be totally nuts to buy this stuff. You're getting record low yields in government securities. And that's troublesome, guys, because that's impacting retirees, for instance. This is an interesting chart from Vanguard. Shows the yield of a 50-50 portfolio, sensibly set up, stocks and bonds. There's different models out there, 70-30, 50-50, doesn't matter. But here we're looking at 50-50, and we're looking at the yield across the 50-50 portfolio. And this is a good way to structure it. Say you got $1 million. Not uncommon for a retiree in the States to retire with $1 million. You put 500,000 in stocks, 500,000 in bonds. You could pick up 4%. Roughly 40,000 a year, and you should be fine. Should be able to live on that. Now look at this. We're seeing the yields drop down way below 2% on this portfolio, and that's causing people to skew. They're actually putting a lot more money into equities than they used to and holding less and less bonds, and it's really wild. You're getting return-free risk, as we call it, when you hold treasuries. It's not that they're totally risk-free. You're exposed to significant risk in the form of interest rate risk, a reinvestment risk, as well as inflation risk. You're not being compensated, guys, with treasuries these days. Once again, we need to look at China to see how to handle things. They're doing it correctly. Once upon a time, America was known for letting industries and companies collapse. Now we're bailing them out. Now we're buying their debt, for gosh sakes. But look at China. They're actually letting companies default. That's the good old-fashioned way. It's very unfortunate they get tarnished with such negativity from the U.S. media. They've done everything in COVID correctly. They're doing everything post-COVID correctly. That's why their GDP is booming, and they're actually letting the unhealthy companies collapse. Not good news if you're holding the corporates of one of these companies, but it's good news overall. So we're seeing a record level of collapse, or defaults, I should say, in corporate bonds. Oh yeah, something really cool happened this week. We saw, and this happened towards the end of the week, we saw 2 big U.S. banks, Goldman and Morgan Stanley, unloading huge blocks of stocks, and they drove some of these companies down 40%. My gosh, it was absolutely incredible. Well, that's what happens when you start pushing huge blocks of shares out there. And rumor has it it's a hedge fund that's entering liquidation, or administration, I should say. Nobody really knows exactly what's going on. All we know is these 2 banks pushed huge amounts of paper out there, incredibly large blocks. And as usual, the way it works, supply overwhelmed demand, price dropped like a rock. Absolutely wild. This is a huge, huge drop. And this is one day that we're seeing here, guys. This is on the 26th. So if you know these names, if you like these names, yeah, you should be buying these names. I won't go near this stuff because, doesn't pay a dividend. I don't want it. But it's really fascinating that they're unloading shares very quickly, even as speculation hits a new record. Here we're looking at margin debt. And it's a new record, guys. We're going back to 97 here. The annotator of the slide isn't me. I didn't do this, but actually said, what happens when this unwinds? Well, we'll see what happens. And I think Friday's action might echo, if you know what I mean. We might see some reverberations of that into trading over the next 5 days that are coming up, starting tomorrow. And we thought we would see a stimulus effect on stocks. Just didn't happen, guys. Not like the last time. People attribute this to Americans now have more choice. They can get out, restaurants are opened up, and there's clubs and sporting events and things like that. So they're not really just in this fear mode any longer, hunkering down in their homes. So they're out there spending the money. It's really interesting to see what's going on. Of course, it's been a very, very good year in stocks. So I'm pleased to see people aren't immediately rushing in. Although I am saying it's unfortunate they didn't put it into Bitcoin. I would have welcomed that. But on the whole, it's good they're not really driving lots of money into shares, because we've had a really good return over the past 1 year. In the S&P 500, 76%. Now, what this chart shows you is it's a histogram, of course, and recall your basic statistics and rules about distributions. That's all you're seeing here is a distribution of returns. And watch this. So we go back to 57, we look at 1 year returns, rolling 1 year returns, and then we construct the histogram. And you can see the mean return sort of biased to the positive side, about 5 to 10%, the average 1 year return. That's a healthy return in the US stock market. I always tell people roughly 7% figure, and you'll be in good shape. You can see on the left-hand side, we've had huge losses, relatively rare, 50% drops. They've happened. Relatively rare. 40% drops, 40%, 45% drops, 35% drops. Relatively rare compared to the center of the distribution, which is the mean, the average return. Oh, but look on the right-hand side. We've had a 76% return over the past 12 months, up to March 22nd. Will that be repeated? Well, anything can happen, but I'm dubious. And somebody crunched the numbers. That was a 4 standard deviation move. And so we're talking once in billions of years. Might happen again. I've seen it before, where the markets confound statisticians. But just be very cautious taking on new positions. All right, guys, that's it. Thanks for your time. 7 slides for 7 days. Go out there and make some money.